How crises make people rich, if they're prepared. Every generation believes its crisis is the worst, the most chaotic, the most historically significant. And every generation is wrong. Crises do not break the world, they reset it. They redistribute power, wealth, opportunity, and risk. They expose illusions and reward those who prepared, while everyone else was celebrating endless prosperity. Crises are not interruptions in capitalism. They are part of its design. And though they destroy fortunes, they also quietly create them. The secret is simple. Crises punish the unprepared, but enrich those who understand how fear distorts value. Wealth does not disappear in a collapse. It merely changes hands. Look back at the Great Depression of 1929. Stocks crashed 80%. Unemployment soared to 25%, and global trade fell by 2/3. It was economic devastation, except for the people who had prepared. Families like the Kennedys, who sold out before the crash and reinvested in distressed assets. Investors who bought prime real estate in New York for pennies on the dollar. Companies like Procter & Gamble grew during the Depression because they recognized consumers would always buy basics. While millions suffered, those with liquidity and discipline built fortunes that lasted generations. Crises do not reward genius. They reward survival. In 1973 and 1979, the oil shocks triggered inflation above 12%, recessions across the West, and a 40% decline in US stocks adjusted for inflation. Most investors panicked, but those who understood energy markets, who saw that the world had become dependent on oil, made fortunes. The value of companies like Exxon and Chevron surged. Gold went from $35 an ounce to over $800 within a decade. Crises do not create wealth. They reveal which assets have been undervalued by complacency. Fast-forward to 2000, the dot-com bubble. When the Nasdaq collapsed 78%, billions evaporated. Entire companies that had been valued at 100 times revenue simply vanished. But amid the ruins, two names quietly emerged: Amazon and Google. Investors who recognized real value beneath the hype earned returns of 10,000% or more. The crisis did not reward those who chased the bubble. It rewarded those who understood that the internet was not a fad, but a revolution priced incorrectly. A crash is not a verdict on technology. It is a verdict on expectations. Then came 2008, the great financial crisis. The world saw the fastest destruction of global wealth since World War II. Lehman Brothers collapsed. Housing prices crashed 30%. Millions lost jobs. Banks froze. And yet some people became extraordinarily rich. Who? Those who had cash and courage. Investors like Warren Buffett, who injected $5 billion into Goldman Sachs on terms so favorable, the bank practically paid him to save it. Blackstone, BlackRock, and private equity funds purchased distressed real estate, mortgages, and entire companies at prices that would have seemed impossible just 2 years earlier. Homes that sold for $500,000 in 2006 were suddenly available for $150,000. That is not catastrophe. That is opportunity wrapped in panic. And then came 2020, the most sudden economic collapse in modern history. A virus shut down the world in 3 weeks. Markets fell 34%. Oil prices turned negative. Entire industries collapsed overnight. But some of the greatest fortunes of the 21st century were born in those months. Anyone who bought the S&P 500 in March 2020 doubled their money by late 2021. Tech companies like Zoom, Shopify, Nvidia, and Tesla surged to unimaginable valuations. Cryptocurrency exploded as stimulus money poured into digital assets. Real estate investors bought properties from owners fleeing cities. Meanwhile, ordinary people hoarded toilet paper, while extraordinary people hoarded undervalued assets. The dividing line was not intelligence, it was preparation. The truth is this: crises do not create inequality. They reveal it. They show who has liquidity when the world runs out of it. They show who can act while others freeze. They show who understands that fear is temporary, but value is permanent. Crises magnify the consequences of your habits. If you overspend in good times, you collapse in bad times. If you save and invest in good times, you buy during bad times. The world reverses its rules during a crisis. The price of assets drops, the price of credit rises, and the price of courage becomes extremely high, but extremely profitable. So what exactly makes people rich during crises? Liquidity, the ability to buy when others must sell. Discipline, the force that prevents panic selling. Patience, the willingness to wait while markets burn. And perspective, the ability to see a temporary disaster as a long-term discount. In economics, prices follow cycles, but human emotions follow spirals. The average investor sells after a 20% drop and buys back after a 20% rise. They do the opposite of what creates wealth. Meanwhile, the prepared investor buys after a 40% crash and holds for a decade. Not because they are fearless, but because they understand that fear is mispriced risk. During the 2008 crisis, the average home buyer disappeared completely. But institutional investors bought more than 200,000 homes in the US alone. During the 2020 pandemic, when airline stocks fell 70%, disciplined investors doubled down on travel companies that would inevitably recover. When Bitcoin fell from $19,000 to $3,000 in 2018, the prepared bought. When it hit $60,000 in 2021, the unprepared bought. Crises invert rationality. The best time to buy feels like the worst, and the worst time to buy feels like the best. Every crisis follows the same script. Fear rises faster than prices fall. The crowd overreacts. Liquidity disappears. Assets become mispriced. And the patient investor quietly accumulates what the panic-stricken investor throws away. Then the storm passes, as storms always do, and capital flows back. Governments stimulate. Central banks cut rates. Confidence returns. And suddenly, everyone asks, why didn't I buy when everything was cheap? They didn't buy because they were waiting for safety, not realizing that safety only appears after opportunity disappears. Crises are not just external events, they are psychological audits. They test whether you truly understand the assets you own, or merely enjoyed the rising prices. They test whether your strategy is genuine or borrowed from a trend. They test whether you see markets as entertainment or as long-term engines of wealth. Wealth is not created in good times, it is displayed in good times. Wealth is created in bad times. And here is the final truth every investor must accept. You cannot predict crises, but you can prepare for them. Preparation is not prophecy, it is structure. It is saving consistently, holding cash or cash equivalents for opportunities, diversifying across assets, refusing to panic when your screen turns red, studying companies before you need to buy them, and training your mind to recognize that market crashes are not personal attacks, They are flash sales on the future. Crises make some people poor because they have no margin of safety. Crises make others rich because they have been waiting for the moment when the world forgets the value of its own assets. Welcome to my channel. Here, we explore not the fantasies of overnight wealth, but the long-term architecture of opportunity. How crises expose weakness, reward discipline, and reshape markets for anyone prepared to act when fear is loud and prices are low. Because in the end, the real question is not how do I avoid crises, but how do I position myself so every crisis becomes a doorway instead of a disaster?